Well, hello everyone. It is Friday, the 22nd of December, 2023. I am Dale Delbridge, Benchmark Realty, Murfreesboro, Tennessee. This is your status chat. We have a lot of tabs to get through today, and they'll all be available over on the YouTube page where the status chat lives, so you can pull in the description and see where we have. We're not going to dive very deep in any of these. We're just going to hit some major points. Now, we're going to read some tea leaves, and we're going to look at the question, is the Fed rate dropping, target rate dropping? If they do that, is that a good sign or a bad sign? If you've looked to buy a house, you know right off the bat, high mortgage rates can really dramatically affect your purchasing power. So we'll get to that right now. If you like this content, please go to CallDelToSell.com, find the tab that says on YouTube, click it, and it'll open up a page of QR codes. There you can use a smartphone to scan and get to the YouTube page, or you can just mouse over and click it on a PC. There you'll be able to subscribe to this little button over here and click the notification bell so that YouTube will notify you when each Friday's blog has been uploaded. Thank you. All right, let's start at the beginning. As I just said before we hit that little break right there, if you've been looking in the market to buy or sell a house, you know that the market has been a mess since the election. And so you might feel pressured and sometimes have some emotions on that. Well, let's look over here at the center panel at our first little graph we have pulled up, first tab. It's from the Federal Reserve Bank of Atlanta. This is the home or the home ownership affordability monitor. Right there it is. Let's slide this up and we can see where we normally would consider, according to the Fed, the affordability, this little index here, is about 30% of your income. And if your income is shot through the roof, this may not apply to you. This is just based upon, I believe, the median. And there it is, median price, home median price of income to go with it. And we see that metro area happens to be the national versus Nashville, Davidson County, Murfreesboro, Franklin area. And we see for a long time we were below national average and we were below the threshold. And then something happened about 2020 and it took a while for the COVID response to come in, and notice that's about a year or so before it started really kicking in, and that's a point I want to make here in just a second. Part of this whole concept of soft landing, which has never been tried before, never happened before, may not be possible, was that there is a delay between actions and results of that action, consequences from the action. If we get right back to the center panel, we see that we got about a year. This was, let's go to January. It's March, April, January 2020. We start going up to about March before we really start to see it rise. But then it shot through the roof. That goes with this. We see the PMI was running about 2964 on a $400,000 median home price with an income to match at $75,000, a little 75.5 in our area. And that made 47% of the income ratio between the house and the income. Now we dropped down here around January 2023. Did you take advantage of that? Maybe, maybe not. We know our rates have continued to climb up there pretty good. And we see that right now we're about 45.8%, just a little bit better than we were back in 22 September. We've done a little bit of improvement. Let's check on something else. 30-year mortgage rates, because that's what we want to know. This is from one of our favorite places, Mortgage News Daily, 30-year fixed mortgage rates, and we see that we're right about here. What time was that? That was 10 of 23. We were at about our peak, and we have come down since. You see this huge drop in rates. And then right after that drop in rates, we start easing back up. So why did we drop down? Well, that's because chairman came out and said we might look at changing the target rates in the future, and then we might have a couple in there. And the stock market went nuts. And then the day after, I think it was, we started seeing other people in the committee saying, we didn't say we were going to be dropping rates. There's no guarantee of it. One member said, we haven't even discussed this. Another one, I think, from the Atlanta Fed said, if we do, it would be put off till the third quarter. So we're looking at the possibility, if there ever is a possibility in the next fiscal year. Market people, I've seen people post on Facebook, people are speculating we're going to get a 1.5% drop in interest rates on mortgages. Don't know how they're arriving at that. With several other drops in there, they're saying 4, 5, or 6. I think the chairman said there might be 3, which was quickly crawfished on and taken backwater, and so the markets are easing back up as we see this little bit of this daily rate start to a little bit come back up, because let's get to this. Somebody has it wrong. recession risks as oil, gold, and treasuries diverge, fund manager says. This is from CNBC. Dateline on this was the 11th. That was, I think, before the announcement from the committee, and we'll look at the PCE today. That's Ms. Katarina Bishop does this. All we're going to really look at from this article, let me slide it up, is this part right here, the bullet points. We're not going to read the article. Markets are confused. I think nobody has an idea. We're in uncharted water. We don't know if the actions of the Fed are going to kick in. Have they kicked in? Have they maxed in? Do we have another year's delay before the full effects are there? We don't know yet. So markets are confused. Economists are confused. Let me just share this with you. There's an old expression that says get 10 economists in a room and you'll get 20 different opinions. It says markets are confused over the risk of recession hitting the U.S. and somebody has got it wrong, according to hedge fund manager David Neuhauser. Falling oil prices and rising gold prices indicate growing recessionary fears, but the 10-year Treasury yield jumped on Friday amid hopes of a soft landing. This would be before we had our discussion, if I've got my dates in order. The CIO of Livermore Partners said somebody has got it wrong here. Is what I'm trying to tell you. It's hard to describe who has it wrong. Well, I would agree, because we're all over the map with this stuff. The Fed doesn't apparently know exactly what they're doing. We've never tried quantitative tightening on this scale, and we had just come off of an easing type process after the COVID response had the economy shut down, and we needed to unkill the economy, bring it back up. Lots of money going in there. Well, we also had this other thing, which is known as the repo market. That's a new tool where the Fed had put in place to free up assets, to take assets off of banks, if I'm not misunderstanding, and give them cash so that they could help boost the economy. Cash boosts the economy and it raises inflation. But coming out of COVID, that kind of made sense. Now that particular chart has gone up and it's coming down there about out of money. That fund is just out of money, because we really don't need to be funding more activity if we're trying to tighten things. And why are we tightening things? Well, how are we tightening things? With the Fed rates. So let's get back over to the main screen. So she talks about that, just about they're beginning to go in different directions. We got the 10-year Treasury rose Monday. And what does that really mean? Well, on average, if people shift, if the yields rise on treasuries, which are generally regarded to be a zero risk investment, if people see zero risk and more return, where do you think they're going to put their money? Well, they're going to put them in treasuries and park it there to see what happens, and they're probably going to hurt the stock market. Because they would, if it doesn't look like things are going well and they get more return, where will they put it? They'll put it in a riskier investment, which is often the stock market versus the government-backed treasuries. All right, are we there yet? All right, so let's get back to this. Now let's look at this. This is a site I want to bring up. It's called the Conference Board's U.S. Leading Economic Indicators. I put the word economic in here, but that's really what they are. They're the leading indicators. And this dateline on this was just yesterday. I had this pulled up for today's show. Let me move me off of this. You don't need to see me. Here we go. The LEI, which is a thing, for the U.S. fell again in November. The latest press release yesterday, December 21st, about the leading economic index and the coincident economic index. We're going to talk about LEI, not the CEI, which is going to give us some of those leading indicators so we can kind of trend what's going on before it happens, the things that tend to be the canary in the cage, before the penny drops, that sort of thing. And we can talk about this. The U.S. LEI continued declining in November, with stock prices making virtually the only positive contribution to the index this month. I want to point that out, with the stock market making basically the only improvement. Now, why would that be important? Well, we just read that we see the Treasury yields have just jumped. And if treasuries jump, what are we talking about doing? We're talking about maybe people moving away from the stock market. Well, what does this say? It says the only positive gain was in the stock market. And this was just yesterday. So it appears that the speculation has fueled some stock market increases, but is that going to last? Well, I have something over here on the left panel, if I can bring it up. Here we are. Now, what we see here is something I extracted from last month, I believe it was. I want to explain this chart. This is the LEI, the leading economic indicators. All right. So this is by the Conference Board. This is just one of theirs. You see this blue line is the year-over-year change in the LEI. That's in the index. And the year-over-year change in the real GDP, because that's really where we define a recession, right? Two quarters negative consecutive makes a recession. And we see, what do we see here? That when these two indicators trend down, we're leading towards a recession. Now, we see when this blue line goes down, when the index goes down, where are we? Headed towards a recession. What about over here in about 2007? Or is that 2008? 2008, there we go, because it's ahead of that mark. We see recession. All right, where were we in COVID-19 days? We hit a drastic drop. And of course, you see the GDP drop because we shut the economy down. We bounced right back with all that spendibus money that we were putting in that we talked about earlier. We want to stimulate the economy back to normal, and then we have a delay. When is this? This is about the 2021 when it skyrocketed and went through the roof. So we started doing our quantitative tightening, and we see the indicators are going way down again. We don't have a gray line here because we don't have the GDP. Real GDP is what they're tracking here, percent change. We don't have this yet negative. So that, I would say, would be something that would be positive. The GDP isn't negative yet. But remember, Q3 GDP was double what it was expected to be, and that may be because people are trying to beat the buzzer. They're trying to get before the credit tightens too bad that they can't get any money to do anything with. Their credit cards are going up, and they're spending because they have to. So let's get back over here to our next tab. So let's look at the GDP. This is for Federal Reserve Bank of Atlanta, GDP now, and this is their little estimator of where they think things are going to be. And lo and behold, look where we are, Atlanta Fed's GDP now estimate. Look at how crazy in the GDP that estimate has become. And now look at where it's going. It's going above 2%. Now it's still above 2% at the last change. Blue chip consensus, you can read this, how they form. It's all down here in the bottom. But all I want to show you is we were looking at being slightly below 1% GDP, and then we look like we're actually coming back up. But now it seems that the best estimates are it's going down. Range of top 10 and bottom 10 average forecast. So this is just trying to hit the middle. Looks like 1%. But 1% is still positive. So that means we haven't yet contracted the GDP in 2 consecutive quarters to get our recession official. And we just looked at the previous chart that says it's not showing recession, but the leading indicators, and you can look at what makes that up, is suggesting that we're headed that direction. And if you look at the previous page where we talked about what the positive was, the only positive was stocks. Everything else was down. It continued to sag and go down. So you can make out of that what you want to. So let's go ahead and look at the next tab. Now, this is CNBC. It says Fed's favorite inflation gauge shows prices rose at 3.2% annual rate in November. Less than expected. It's still up 1.2% above where we want it, but it's less than expected. Let's print that out there in big letters. Published Friday, December 22, today. Mr. Jeff Cox, CNBC. You'll have this link to read it. Let's slide down to their biggest points here. It says the core personal consumption expenditures price index, the CPE, which is what the Fed looks at, rose just 0.1% in November. Look at the way they're spinning this to us. Rose just 0.1% in November and was up 3.2% from a year ago. So both of these, even if it is 0.1%, it's in the wrong direction. And so inflation has not been tamed. Our GDP is still going to be positive. So what does that tell you? We're probably going to continue quantitative tightening, which means higher for longer. So which means to me that the people who heard what they want to hear out there in the financial world, where they heard, oh, rate cuts, peak Fed, probably are going to be disappointed. Somebody has got it wrong. Who is it? I don't know. We'll figure this out together. So here on a 6-month basis, the core, now notice whenever they separate the core of the indexes out, it's because they want to spin it. The core PCE was up 1.9% below the Fed's 12 months target. All right. Including food and energy. This is a key one. Including food and energy. The so-called headline PCE actually fell 0.1%. Now, why is that? Because oil prices have come down. The oil prices, the future, the estimations that we're going to need. Look, you know about supply and demand chart, right? Okay, what makes a price go up? More demand or lower supply. What makes the price come down? Higher supply, lower demand. So if we've changed, what caused this? Is it because the Biden administration has reversed its draconian war on oil, energy? Have they changed the policy that you and I haven't heard? No, well, it's probably not going to be an increase of supply that then drops the prices. So what's likely to cause oil to go down? In my mind, if we haven't adjusted the supply side, we're probably looking at a decrease in demand. And generally, since energy is an input to the economy, if we're looking at lower oil prices, it's probably because people are thinking they're not going to have as much demand. That's just my crazy talk in my head. Crazy talk, I know. So here we are. We're back on this. That's all we need to look at on this article. Remember, they'll be posted over here. Now let's look at the 10-year treasuries. Okay, now this was, let's see, today as well. 10-year treasury bond yield, what it is and why it matters. Now this is from Investopedia. We've got this updated today. How about that? We couldn't be any more timely than that. Julius Mensa, Michelle Logan, or maybe it's Michael Logan here. I wish that video would stop being distractive. But here we are, 10-year Treasury bond yield. What is it and why it matters? Well, if we want to look at this, it'll bring down here to their takeaways. Key takeaways: Treasury securities are loans to the federal government whose maturity range from weeks to 30 years. And by the way, on quantitative tightening, on the repurchase agreements, those are usually go back to the banks, they catch them. But when the Fed buys the debt, they can buy the debt or it can just retire. If the treasuries matured out and they're no longer there, they can just evaporate that money off of the books. So the Fed can reduce the money through quantitative tightening. It's just the opposite of easing. Easing is putting more money out in the market, in the place for the world to use, for the economy to use. Tightening is trying to take some of that back, because what does easing do? It causes inflation. So how do you cut inflation? You cut that down. You also cut inflation by raising the Fed rate, because it has an immediate response to people with credit cards, because they're usually tied to it and revolving credit. So how can we influence with the Fed's interest rate the quickest? Credit cards and people like that. So people been buying like crazy. They've got those credit cards maxed out. I had last week I showed you the debt, household debt, all-time high, but people didn't stop buying. So we still had that hyper active economy going. People were buying. It's just all on debt right now. All right, Treasury securities, we're on the second dot. Treasury securities are considered safer investments relative to stocks because they are backed by the government. And that's right back to what I said about somebody's got it wrong, or actually that hedge fund manager says somebody's got it wrong. Why? Because if the LEI says the only positive things was stocks going through the roof, if we have greater Treasury yields, which are, did we say? They are generally zero risk. If we get a bigger payoff going to a zero risk type situation, we're going to spend our money there, not the stock market. So we're probably going to shock the stock market. It's probably going to come back down pretty quick, because it really pretty well much. Again, if you watched last week's episode, you saw the stock market doesn't always track as people would think it would track. So here we go. Bond prices and yield, third dot. Bond prices and yield move in opposite direction, which means that falling prices boost yields and rising prices lower yields. So there we go. Our prices are falling, our yields are higher. They'll probably go into that. The 10-year Treasury yield is a proxy for mortgage rates and has also been seen as a sign of investor sentiment in the economy. We talked about that last week as well. It doesn't always track. And if we're looking at slowing real estate volume and people staying in their homes longer, if they don't have, for the percentage of the homeowners that have a mortgage, that's going to have a long-term effect on when those mortgages are expired. They either expire or they fatigue, they go off by a refinance. So either way, they're going to, if rates are high and the market slows, they're going to stay in there longer. And so it's not a one-to-one direct correlated thing like it might appear. The last one says a rising yield and falling demand for Treasury bonds, which means investors prefer high risk, high reward investments, while falling yields suggest just the opposite. Let's look at the last thing we have here. This is where the big thing is. Let me make my face go away. Answer the question. If the Fed drops the Fed rate, is that good or bad? Well, I have charted here unemployment in the red line. I have charted the blue line is, of course, the federal funds effective rate. Now, if we go through what are we seeing in here? How do these things work? Well, when the Fed lowered the rate, the effective rate, what did it do? Unemployment went up. All right, let's check this other one here. Back here around 1960, Fed lowered the rate, unemployment went up. Let's check, see how we're doing here. All right, here we are in 1970. Fed had gone rising, right? And then it drops the rate. When did it drop the rate? Right at the beginning of the recession. Unemployment went up. What about this one? 1975, we had a little jitter ahead of time, but as soon as the recession hit, there we go, it came back down. Unemployment, though, went up accordingly. So this little adjustment didn't help any. If we go all the way through here, we're going to notice this trend that when the Fed drops the rate, there's a recession. Here's another one. 1990, Fed drops the rate, unemployment rises with a recession. Here we are in about 2000, was that 2000, November, end of 2000, we see the Fed drop the rate. There was a recession, unemployment went up. So here we have it about 2007, 2008, we see Fed dropped the rate, unemployment skyrocketed. Here we have the COVID-19 thing, Fed dropped the rate, inflation, unemployment still skyrocketed. And where are we going? So here we are, as we changed this trajectory on unemployment, and it kind of started rising just a little bit. What do we do with the Fed rate? We started tapering that off. So the question will remain, which is going to be the deciding factor? Which is going to be the bigger threat? If we drop the mortgage rates indirectly because of that market, if we drop the target rate, which will loosen up credit card debt that for people who haven't defaulted, if we drop that rate, we would normally say dropping that rate is a good thing. But why are they dropping that? Because we still have too much money out there floating in the economy, and the Fed can only tighten so fast without scaring the stock market to death. So there we are. What does this all mean to you? Whatever, I guess, however you want to interpret it, because somebody has got it wrong. Now, who is that going to be? I don't know. All right. Well, we've talked plenty long on this. As you can see, sometimes something that looks like a good thing isn't actually all that good. It's the question of why they do. When we get to the end of this road, how those things the Fed sees bounce around in there, they're going to try to hold, is what I'm reading they're telling us. They're going to try to hold higher for longer, and that means higher rates. They're not really going to drop that down like everybody and their little dog is screaming, barking out here, rate cuts, rate cuts, rate cuts, buy a house, buy a house. They're going to be better in 2024. And all that's doing is getting everybody now to just kind of wait for something that the Fed is not really indicating is going to happen. If you look at the latest things, and we see the PCE only went down by what, 0.1%, and that's because of oil. But why did oil go down, right? And we look at the LEI. Why did the LEI go down except for what section? What sector of the LEI? What indicator in there went down? Stock market. And why? Because the stock market jumped on. They heard what they wanted to hear. They heard that we're peak Fed and the money's coming down, and the stock market jumped. But is any of this fibrillation real? That's up to you to decide. Now let's wrap this show up. Hello, I'm Del Delbridge of Benchmark Realty, Murfreesboro, Tennessee. If you are currently unrepresented and would like to know how to compare up to 3 properties side by side and room by room, then go over to my new YouTube channel, CallDelToSell. That's 1 L and Del, no spaces. Watch the demo on Real Scout, and then call me and we'll set up your exclusive ad-free account today. All of this has got me pulling my hair out. I tell you, if it's stressful on me, it's got to be stressful on other people. The unknown is what makes us try to guess the market so much. And the only thing I can really tell you is if you're gambling on the future, that's a risky bet. We can't change the past and we can't see the future. So about the only thing we can really do that's responsible, I think, is deal with the here and the now as best we can. Because now is the time, I think, to do some of this. Because I really meant to get into, but I talked so much I couldn't get to it, is with the unemployment comes credit tightening. If we went back, I'll do that next week if I don't forget. If we look at home prices, the home prices during the 2008 crisis took 2 years because nothing turns around overnight. It slowly went downhill because things just don't stop on a dime. And so it took a while for that to work its way through the economy. And unemployment is a big portion of it. People were not willing to, in the middle of a banking crisis, just continue the craziness of the high-risk loans. So everything tightened up. Nobody wanted any more bad debt, and it just made that price slide go very, very slowly. We'll look at that next week maybe. So let's look at our numbers. 12/15/23, that would be last Friday. We had 20,095 opportunities in the Real Scout system. That was down over the previous period. We had 31,112 in the under contract still showing, and that also dropped a little bit. And we see that we transition into 15%, the integer ratio between those two numbers. Dropped down from 16. Today, the 22nd of December, 2023, we have 19,762 opportunities in that same system, which is down over the previous period. We have 2,976 in the under contracts still showing, so it looks like it's going to tip down. And we had a drop to where we are right now. We're at 15, almost transitioning toward 14. So there we have that. Now, here's the thing. Just because mortgage rates come down doesn't mean that's the only thing involved in our life. And if the Fed has to drop the mortgage rates to spur the economy because we have gone negative on the GDP, which we have not yet done, that these things tell me that we're probably not going to drop any rates in March like some people are predicting. I lean more to the Atlanta Fed's head honcho, who says maybe third quarter of 2024. That's it. Appreciate you watching. Have a Merry Christmas or Happy Holidays. If Merry Christmas offends you, I'm not trying to be offensive. Have a Happy Holiday. Take care. Be safe. Stay warm. And we'll see you next time.